So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to answer the question, should you withdraw money from your investment account to pay monthly expenses? So in this case, I wanted to read actually a member email that I got. And as you guys know, I get a lot of these emails, which it serves as the basis for a lot of the questions and topics that come up on the Daily Call. So if you want to get your question answered, or if you have some topics that you haven't heard us cover yet, please go ahead and shoot me an email, send me a tweet, Facebook message, or submit your question at optionalpha.com/ask, which is the best place to go. So this person said, well, what are your thoughts on withdrawing money from your account to pay for expenses? I know that you prefer to take a standard monthly draw, but what percentage of your account is too high where you risk having to constantly decrease your account size? Obviously, in an ideal world, your monthly expenses would be low enough that if you were a very small percentage of your account size, you could handle it. But what do you consider to be a safe level where you can continue to grow your account? Have you ever considered withdrawing a percentage of the monthly profits for smaller accounts where you have a strict monthly amount that might cause too much of a drawdown in total account size? So the idea here is just trying to find this wiggle room of where is the perfect amount of money, or how do you calculate the perfect amount of money to withdraw from your account? Now, there's a lot of talk on the 4% rule or the 5% rule as far as like an annual draw from your portfolio. And although it has a good merit as far as basis for guideline posts that we can potentially use, it doesn't always serve as the principal amount that you should necessarily take from your account. And what I mean by this is that when people talk about, say, the 4% rule for finance and withdrawals, that takes into account a lot of different things that could happen based on when you start actually taking a 4% draw. In many respects, that 4% rule was done on research that was in the bottom of a market and started to have this huge bullish uptrend throughout the end of the research. So what this means is that if we start drawing money on our account based on a percentage, maybe we want to allocate a little bit less of a percentage during the top of a market and potentially more of a percentage during the bottom of the market. So to put number to paper, I guess, if we are at the top of a market, which I think we are right now, or at the top of a cyclical cycle, you maybe want to start withdrawing less than 4% from your account, because there's a good chance that if you're holding a big stock portfolio, or if you're holding too much long equity exposure, you could lose some of that value. If you're holding something at the bottom of the market, so say we were at the bottom of the market in 2008, 2009, and you wanted to start withdrawing money, maybe you could do something at or a little bit above 4%. So maybe 4 or 5% from your account per year. I am not a fan of doing the percentage basis. So my thought process on withdrawing money from your account is to figure out what your monthly expenses are, do all of the personal finance stuff that we don't even have time to get into, but things like pay down non-preferred debt, get rid of all your student loans, all your credit card debt, right? Any lines of credit that you have, reduce your monthly expenses as much as possible. What me and my wife did is we ended up moving from outside of DC to Pennsylvania. So we had a drastic change in living expenses. That was about 5 years ago. We actually made that move and ended up reducing our expenses dramatically. We don't have any ancillary stuff. We've done all the right financial, personal finance stuff that you need to do. And I truly say you have to do that stuff first, right? So pay down all that stuff first. Try to allocate some of your resources towards non-preferred debt or high interest rate stuff that you have. Once you do that, figure out what your minimum monthly expenses are going to be, the minimum amount that you truly need to live off of after you've cut everything else out. And I suggest, if you have enough money in your account to do this, and if you're at the point in your life in which you feel like you can retire from doing this, then I suggest just taking a monthly draw or salary. Now, me and my wife calculated this figure for ourselves, and we've literally lived within this same figure now for almost 8 years. So we've done the same monthly draw, month in, month out, every month, no matter where our portfolio goes. We take the same monthly draw. And that forces us to keep our expenses low, even in the face of rising prices like food prices now with kids and diapers. We've forced ourselves to cut back on other things to keep our budget within the monthly draw that we take. And I think that you should do this because when you start allocating for percentages, what you end up doing is psychologically you start changing and you start maybe wiggling and shifting a little bit more than you should. And so one month you say, I'll take 10% of my profits. Well, the next month, if you don't have profits, do you still take 10% or do you take 8? And now you've started to immediately start wiggling and shifting your number, and to the point at which I think it doesn't serve its purpose of being an automatic safety net or income source for your family and for your future. So that's my opinion on it. I think if you are at the level that you can start taking money, and you would know if you are or not, then I think you should start taking a little bit out and slowly start increasing that to a minimum monthly standard. And again, I think that everyone should know if they're at that level or not. You would just have a gut check, feel comfortable enough, retiring off of your trading account and the money that's generating. And if not, you're probably not at that level. If your gut is telling you right now, I don't know if I could do that, it's probably not the best thing to start taking money out of the account. You want to leave money in the account to let it grow. So hopefully this helps out. As always, if you guys have any questions, let me know. And until next time, happy trading.
Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.